Okay, so you're about to learn the exact mechanics of bridging that massive gap between a theoretical, perfect spreadsheet and a highly profitable, stabilized real estate asset. We're stripping away all the fluff today to show you exactly how top-tier sponsors actually secure capital, close these transactions, and relentlessly lead their operational teams to bring a business plan to life. By the end of this explainer, you're going to have the blueprint to stop just analyzing the numbers and start actually executing deals.
Look, there is a stark contrast between a theoretical model and reality. I mean, it's incredibly easy to just sit in the safety of a spreadsheet, right? You plug in a quick 3% rent bump, you compress the cap rate a bit, and suddenly, boom, the deal looks like an absolute home run. But the harsh reality of being a sponsor, it's entirely different. A sponsor doesn't just hit calculate. They're out there negotiating with lenders, they're managing 3 a.m. plumbing disasters, and they're literally forcing a property to perform.
And really, that brings us to the absolute core takeaway for this entire analysis. Underwriting simply establishes what a property could do. The operational business plan dictates what it actually does. Because, let's face it, spreadsheets do not fix broken plumbing, and they certainly don't collect delinquent rent. Execution does. A truly bankable business plan is what translates those theoretical financial assumptions into hard, non-negotiable operational milestones.
So, let's get into Chapter 1, the blueprint. Formulating the operational business plan. Okay, let's dive into this. Before a single dollar even changes hands, you need an ironclad blueprint. Every successful deal starts by identifying the core thesis. You have to clearly define your primary value-add lever. Are you doing a heavy operational turnaround, where you focus on expense reduction and occupancy recovery? Are you doing a physical renovation, upgrading unit interiors and exterior amenities? Or maybe it's a strategic repositioning, where you completely re-tenant and rebrand the entire asset. Once you have that exact thesis locked in, you have to map out your CapEx, your capital expenditure, phasing month by month. It is absolutely crucial to strictly match your CapEx draws to your projected downtime and rent premiums. Once the plan is set, we need our KPIs. The first vital metric? Keeping your bad debt strictly under 1.5%. Listen, uncollected rent is the silent killer of cash flow. If you model massive revenue but allow bad debt to just quietly creep up, your business plan is absolutely going to fail. Pivoting to our next vital operational goal, enforcing a renewal retention rate of 55% or higher. Turning over a unit is just wildly expensive. Between the vacancy downtime, the make-ready costs, leasing commissions, losing a tenant burns through capital fast. Retaining at least 55% of your renters is critical for stabilizing your net operating income timing. But hey, we don't just plan for success, right? We plan for reality. Downside sensitivity is crucial here, which is why when you formulate your blueprint, you absolutely must model delayed absorption. You have to model interest rate expansion, and crucially, you need to include a 10 to 15% CapEx contingency buffer. That buffer establishes the working capital reserves you are desperately going to need when costs inevitably run over. Now that we have a bankable business plan, we have to look at the hardest part, convincing the money. Chapter 2, Pitching Debt and Equity. And this brilliantly illustrates something you have to realize. Equity investors and debt providers evaluate risk through completely different lenses. You cannot give them the same pitch. Lenders care heavily about downside protection, loan repayment, and collateral value. They're typically looking for a debt service coverage ratio of 1.25x or higher and a debt yield somewhere between 8.5% to 10%. Equity partners, on the other hand, they care about the upside potential and alignment of interest. They are heavily scrutinizing your internal rate of return, your equity multiple, your cash-on-cash yield, and whether you actually have your own skin in the game through a co-investment. So I want you to think about this. Knowing that you have two entirely different audiences with two entirely different sets of return hurdles, how do you actually package these complex metrics into a compelling narrative? I mean, how do you build a pitch deck that actually gets funded? Well, you follow these 5 critical steps. First up, the executive summary, detailing the total capitalization, your target returns, and your 3 to 7 year hold period. Second, location dynamics. You literally have to prove the submarket job growth, the demographic trends, and the supply pipeline. Third is the property overview, where you compare your purchase bases directly to recent sales and replacement costs. Fourth, the value-add strategy. This requires a highly detailed before and after rent roll analysis and an itemized scope of work. And finally, number 5, the financing strategy, clearly outlining your debt terms and exactly what your target exit cap rate is going to look like. With the capital secured, the real test begins at closing. Chapter 3, the reality.
day one execution. Everything up to this point, that was just preparation. Now, your operational success depends entirely on aligning your third-party property management with your aggressive asset management strategy. And honestly, that alignment has to happen well before you close. We generally look at this in 3 distinct phases. The pre-closing phase, which is 30 days out, the frantic day one transition, and then your relentless weekly asset management cadence.
During that pre-closing phase, 30 days out, you are hunting for opportunities. You've got to finalize the annual operating budget and approve the initial chart of accounts. You need to audit every single active service contract, trash, landscaping, security, specifically looking for day one cancellation and rebid opportunities so you can capture portfolio level pricing. And this is non-negotiable. You and your regional manager must physically walk 100% of the vacant units and the mechanical rooms. Absolutely no surprises here.
So, the crucial point is this. On day one, you must immediately distribute official ownership transition notices with your updated payment portal instructions. You literally have to reconcile tenant ledgers immediately upon takeover to aggressively tackle existing arrears. You are setting the operational standard from the very first hour you own the place.
And after day one, you shift right into that relentless weekly cadence. You're tracking weekly leasing traffic, you're watching conversion rates. But the single most vital operational target you must hammer home to your team is turning vacant-ready units in exactly 5 to 7 business days. Listen, every single day a unit sits vacant just waiting for a contractor is cash flow evaporating right into thin air.
Now, to actually maintain this discipline, you have to compare your operational reality against that original spreadsheet every single month. You take your monthly actuals and you stack them up directly against your underwriting budget. You absolutely must flag any variance greater than 5% across revenue or controllable operating expense line items. Seriously, if your trash contract comes in 6% higher than you modeled, you investigate it right then and there. You do not wait for the end of the year.
The bottom line is this. You can build the most elegant, complex financial model in the entire industry, but real estate isn't one in Excel. It is one on day one, through ruthless contract auditing and exact execution. Stop just analyzing theoretical upside and start aggressively executing. The real question is, are you ready to step up and become a true sponsor, or will your next deal remain forever trapped in a spreadsheet?